Hi everyone, welcome to my channel. I'm Doris. I'm here to show you about market updates. And today we're going to be wrapping up on the US debt, the bond market performance in the past ever since the summer, and the US debt pile-up affects the interest rates. And the Fed will have to step in and make appropriate monetary policy adjustments. Former Treasury Secretary Lawrence Summers said that the Fed will at some points have to intervene the government's mounting debt because of its impact on interest rates. Over time, the Fed, as the determinant of national monetary policy, will have to participate in some of the U.S. Treasury debt issues because it has been piling up recently. As U.S. Generally favors the more expansionary fiscal policy, also social services and like Social Security and the Medicare costs are also piling up. It means that if the debt increases and the deficit rises, it means more demand in the economy. It'll raise the current neutral rate and further raise the expected neutral rate in the future. Concern about the U.S. fiscal position sent Treasury yields soaring, which surprised policymakers and prompted them to consider a moratorium on another rate hike. Total outstanding U.S. debt exceeds $33.5 trillion. Summers' remarks came a day after Fed Chairman Jerome Powell said neutral rates could rise in the short term, but it was hard to know exactly what it would be in 5 years. Neutral interest rates, also known as R-star, means that the monetary policy neither stimulates nor limits the interest rate level of the economy. Federal policymakers estimated the neutral rate at 2.5% in their September forecast. Summers sees the real neutral rate between 3.5% and 4%. When you try to sell a lot of long-term debt because the deficit is very large, its price falls, which means that the long-term yields rise and the term premium rises. Term premium refers to the compensation required by the investor for assuming the risk of an interest rate change during the period of the bond. Mr. Summers said the widening of the fiscal policy gap reached the neutral rate, pushed up neutral rates, meaning that the Fed must raise real interest rates to maintain the same level of balance between the accelerator and the brake. Interest rates and the term premium to rise have a restraining effect on the economy. The former Treasury Secretary has yet to see evidence of insufficient liquidity in the Treasury market, but said the Fed, especially the New York Fed, which oversees and supports market functions, should focus more on ensuring that the financial markets work well, perhaps with less analytical statements about neutral rates. I think this will help the system to fulfill its functions. That's all I have for today. Thank you for listening. Don't forget to subscribe and see you next episode.